Hello everyone, Andrew here with Kimball Realtors, and I'm going to talk to you today about mortgage rates and more importantly, how your credit score affects your mortgage rates. So if it's your first time here, thanks for stopping by. I hope you subscribe. If you've been here before, please hit the like button. Comment down below if you have any comments on what videos you'd like to see. We do real estate videos here on our channel. And again, if you're new, thanks for stopping by. Make sure you subscribe. Like and comment for us. We appreciate it. So let's get right into it. Everyone's talking about the mortgage rates and how these low mortgage rates are fueling the seller's market, and that's kind of what's happening right now, which is partially true. There's a few factors in there, and I talked about that in detail in one of my other videos. But I want to talk to you about your mortgage rates and how your credit score affects the mortgage rate. Because as of right now, and today is June 15th, as of right now, the average mortgage rate in the United States is 3.1%. That's an average though. You could get a higher or lower mortgage rate depending on your credit score. So I'm going to give you an example here. If you are getting a $200,000 loan on a 30-year fixed loan, if your credit score was 620, your interest rate would be 4.13%, making your monthly payment $970 per month. Now, if you had a 760 credit score, you could get an interest rate of 2.55%, making your monthly payment $796 a month. So right off the bat, you're saving $174. And this actually came from the website MyFICO. That's where they've got a little calculator on there. You can figure this out. It's not a lot of your mortgage calculators, but this particular one was called MyFICO. But with that 620 credit score, with that $970 a month on a 30-year note, you're going to pay $149,000 in interest. If you had a better credit score, that's 760, and you got that 2.55% interest, you would only pay $86,000 over the 30-year note in interest. So that's a difference of $62,000 over a 30-year note just because you had a better credit score. Now, a lot of people don't understand their credit score and what goes into it, so I'm going to touch on that just briefly here. You're probably better off to talk to your mortgage lender or your banker to talk to you a little bit more about the credit score, but I'm going to tell you a little bit about what goes into your credit score, what makes that up. The biggest thing that they look at when they're going to determine your credit score is your payment history. So if you've got credit cards and mortgages, that's all going to go into a payment history, and they're going to look that you are on time with your payments. When you start missing any payments or are late on payments, it's going to start bringing your credit score down. So it's very important that once you're establishing your credit, that you make those payments on time, because that's kind of the biggest part of your credit score is actually the payment history. Then they look at the amount that you owe. So they want to look at the amount that you owe versus how much credit you have. It's a percentage they would like you to be at. So let's just say, for example, you have a credit card that has a $5,000 limit. If you've used $4,000 of that limit, that's going to affect your credit score negatively. And if you've used less of that $5,000 limit that you have, that's going to have a better positive effect on your credit score. They also look at the length of your credit history. And what I mean by that is like how long you've had your longest credit card. So, if you're 30 years old and you got a credit card when you were 20, you've now got a 10-year history. That's good because you want to have, they're looking at that, the length of your history of your credit for your credit as well. They also look at the credit mix, meaning what type of variety of credit cards do you have? Is it credit cards? Is it store cards? Is it gas cards? Is it a mortgage? Is it an auto payment? So they're looking at the variety of the credit that you have, what they call the credit mix. So you don't want to have too many credit cards versus maybe you don't even have an auto payment or store cards. So they're looking at your credit mix. That doesn't affect it quite as much, but it does affect it. And they also interestingly look at new credit. They look at when's the last time you applied for a new credit card and how often do you apply for new credit cards. So you want to keep that in mind when you're looking at trying to improve your credit score. Try not to be getting new credit. Try not to get new credit cards. Try not to get, like if you go to a store and they offer you a store card. Try not to get those when you're going to, you're going to be getting a mortgage, because that's going to keep your credit score low, and you want to keep it high. Because again, in the examples that I showed you there, you can save, $100, hundreds of dollars a month, thousands of dollars a year because you were kept your credit score high. So it's very important that you keep your credit score high. I hope this helped you out today. Let's say I just kind of touched a little bit on it. If you liked it, please like, comment, and share. Comment down below. Tell me what you think of it, and also what else you'd like to have us do videos about. And if you're new here, thank you for stopping by. Please subscribe. And as always, if you're in the Wisconsin Dells area and you buy or sell a home with Kimball Realtors, we will give you a free Kimball Realtors coffee mug. There is a limited time offer because there's a limited supply, so act now.